So what I want to do in this video is talk you through how inheritance tax works in the UK. Last week, Rachel Reeves brought pensions into the inheritance tax kind of like regime. Really, really big change. Previously, that was not the case. Now, this will impact people and mean that you might actually hit your inheritance tax threshold where you start to pay inheritance tax a little bit sooner, or at least your kids will. So how does it all work between yourself, your spouse, and what are some of the things that maybe you can look out for so that you can track them and start to kind of be aware of when you might actually cross over that inheritance tax threshold where your kids are going to have to pay some inheritance tax. I'm going to do a little bit of a scribe because I thought this would be the best way to show you how this works. But first, let me just set this up for you. So this is how inheritance tax currently works at the moment. So as a married couple, you can have Mr. here and you have Mrs. here. Combined between the two of them, there is an inheritance tax allowance of £1 million. And that consists of two things. It consists of the nil rate band, which will basically be assets that you hold, cash, investments, now pensions, because that's lumped into this category right here. That's £375,000 that you have as an allowance. On top of that, you also have a residence nil rate band, which is when you're passing down property to your kids. Now, the limit for that is £125,000. So both Mr. and Mrs. get £500,000 each, which means that the total allowance before you begin to pay inheritance tax is essentially £1 million. Now, £1 million is quite a lot of money, admittedly, and I think also within this planning for inheritance tax, the ideal situation is that you start to dwindle or at least use your asset base. The money that you have is probably going to be the easiest route that you can take. Start to spend the money that you have so you can stay below this £1 million threshold. Now, when it comes to property, that can be a little bit more difficult because if it is your residential property, and it will be your residential property that this accounts for, if you live in a place like London or you have a property that's worth maybe £350,000, £400,000, then obviously that's not something you're going to be able to spend essentially. So using your assets wisely and efficiently is going to be absolutely crucial. Now, what happens on death? Because inheritance tax is due upon death. So let's just say Mr. dies. What happens is that Mrs. will inherit Mr.'s £500,000 allowance, which means that with Mrs., she still has the £1 million available to her because they've been married for a period of time. Now, inheritance tax isn't due until death of both parents, where the assets that have been accumulated now need to be passed down to children. So you have Chris, Liam, and Abby in this diagram here. Now, let's just say at the point at which that happens, the estate is now worth something like £1.4 million. In this instance, the additional £400,000 over and above the £1 million will be subject to tax at 40%. And that right there is quite a lot of money. Rough calculations, £160,000 would be due. Now, obviously, when you're planning for this, one of the smartest things that you can do is to make sure, again, that you're using as much of your cash assets as possible so that you can reduce this number as quickly as you can before this happens. Now, many people say this is a luxury to be able to have, £1.4 million. So you have a tax burden of £400,000. Well, a taxable net asset base of £400,000 to be able to pass on to your kids. But it's important to note that it's your kids that have to find this £160,000. So forward planning is really important. And I kind of want to talk a little bit about that next. Now, there are lots of things that you can do to help mitigate inheritance tax. And the reality is that the allowance is pretty generous. It's £1 million. A lot of people are never going to get there. But if you are worried that you, at some point during your career, your working life, will hit that £1 million, and you don't want your kids to be lumbered with that bill, then it's really important to be proactive and start to think ahead. And that's probably one of the things that I've kind of noticed during my career is that oftentimes this is very much an afterthought. People think about it when either a family member is about to pass away really, really poorly, or health has deteriorated, or they're not of sound mind to be able to make that instruction to take these kind of decisions. So forward planning is really important. Now, there are lots of things that you can do, but I think the first thing is be aware of what your estate is worth. So everything you have, investments, cash, pensions, ISAs, property, know exactly what that is worth, because again, between the two of you, if you're married, that's £1 million. But if your property is worth £600,000 and you've got a pension that's worth £300,000 and you've got other cash and other bits of pieces lying around that will take you either close to that £1 million threshold, then you need to know where you are so that you can be aware of whether you're going to breach it or not, and whether you actually need to do something. So be aware of what your asset base is. And by the way, if you're not married, if you're a single person, you've never been married, it's £500,000. So please be aware of that. Many people say that you won't be dragged into it. As a single person, it's possible, particularly if you own your own property and you've got a property worth £200,000-300,000 and you're really good with money you've invested over the period of time. I would argue property plus pension will probably get you there as a single person. So please be aware of that. Track your asset base. Now, in terms of things you can actually do, I can't tell you what you should do, because at the end of the day, for these type of matters, you do need to see a financial advisor who can actually plan the right strategy for you. You can take out insurance policies, you can write trusts, but the question is, what kind of trust do you write? Do you write an absolute trust? Do you write a discretionary trust? Do you write a discounted trust? What do you do? Do you do a loan trust? No one's going to be able to tell you what trust that should be in a YouTube video. I mean, I could run through the details and you can make your own decision, but would it be the right one for you based on all of the legislation, all of the fine print that sits behind inheritance tax planning? So you have to see a professional to help you do that. And I know that for many people watching YouTube, you want to be able to go off and do it on your own. This is something that you need to get some guidance on. Now, I've seen people take out insurance policies for example, in the scenario that I just run you through, there's a £400,000 liability potentially. So the asset is worth £1.4 million, £400,000 over the limit. So with a 40% inheritance tax bill to pay, that's £160,000. I've seen people take out an insurance policy for £160,000. That can work. But again, if your estate increases in value, the insurance policy may not be enough. So it's really important you take some advice with this, but that's how it works currently. And I think the more we're educated on this type of thing, the better position we're going to be to make informed decisions. And that's the whole purpose of this channel. That's the whole purpose of this video. I'd love to know what you think. Are you going to be in that threshold? If you picked up anything new from watching this, please do let me know. Until next time, I'll catch you later.